The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Live from Studio 2 at Bloomberg headquarters in New York, I'm Scarlett Fu.
And I'm Alexia. We're kicking you off to the closing bell here in the U.S. It looks like we're not going to get 45 record closes for the S&P.
We need to take a breather once in a while.
Spoiler, it's true. And like a little breather, because let's be honest, we're not even down that much. We're just down 0.3%. Yeah, we're around the lows of this session. But again, I feel like I say this every day. It's not much of a move. The volume isn't really there. We are seeing a little bit of an increase in the VIX. Now we're over 2020 is that line that many volatility investors tend to look at. I did want to point out, Scarlett, what's happening with the curve, that 210 spread. We're now around 9-10 basis points. The steepener still seems to be in play, right? But to me, it's like, why the steepener? Is it because we're seeing lower 2-year yields or higher 10-year yields? And the difference between those two today, well, we kind of got both.
Well, and it all comes back to how the Fed's plans to cut rates just got more complicated following the latest CPI and jobless claims reports. Now, the upshot here is the central bank can't claim victory yet over inflation, right as weather events muddy the labor market outlook for weeks to come.
T-minus 1 day to the official start of earnings season. You got big banks really kicking things off. Watch for pressure on the revenue line in this new era of rate cuts. Delta out with numbers today as well. That stock down slightly on its earnings.
And Hurricane Milton's aftermath. The storm batters Florida, triggering deadly tornadoes and leaving more than 3 million people without power. We assess the economic damage.
All right, back to that CPI report. Several guests on Bloomberg TV today speculated what that data means for the Fed, with the meeting now under a month away.
From the Fed's perspective, look, if the economy's in good shape, we can just gradually bring rates back to a normal level.
The Fed is on an easing path, and I think that's what's important. If you look at the distribution of what's being priced in the SOFR market or the futures market, traders and investors are really thinking, okay, the Fed is protecting the downside here.
We're not sure the Fed has everything under control the way that they want to, and that is a risk. The last thing the Fed wants to do is stoke those flames of inflation, have that move higher as we head into the end of the year, and have to actually raise rates again.
Inflation is still slightly above the target, but is falling. And the fact that it's actually not falling as much is a signal that economic growth is actually not even a soft landing scenario, but maybe in a no landing scenario.
It's kind of like a Rorschach test, but something that it actually has done is price out cuts for 2025. So this takes a look at the Fed easing potential from December 2024 to December 2025. And you can see that steep re-rating that we've had in just a couple months' time. We went from all the way to 170 basis points, now up to 115 basis points. It's sort of like, do you follow the initial jobless claims, or do you follow the inflation data? Or is it okay, as Bostic says, Scarlett, to take a break?
Yeah, all good questions. So let's put the questions to Diane Swonk, chief economist over at KPMG. Diane, let's start off right there. Today's data signaled inflation that was hotter and labor market that seemed to be cooling. If this trend continues, which of the Fed's mandates take precedence here? Tackling inflation or supporting employment?
Well, I think what we're seeing right now is, first of all, the Fed took that outsized first cut, and the markets got way ahead of them in terms of how much additional rate hikes. What we saw in the minutes yesterday to that Fed meeting was that it was pretty a lot of pushback to actually getting to that 0.5% that they got. And you saw in Raphael Bostic's comments today that he wouldn't mind skipping an extra quarter-point cut. I think the problem is that we're going to see so much noise from everything from the hurricanes adding to the weakness related to strikes in the aerospace industry and the fallout of that in terms of layoffs. And on the other side of it, the hurricane disruptions also add to supply chain problems and could buoy inflation a bit as we get into the end of this year and early next year.
So how do you take that? I mean, what's the possibility that we look at a reacceleration of the economy versus a lack of disinflation versus nothing actually really changed, just keep on going straight?
Actually, I think what we're going to see is a lot of mixed messages. The Fed, I still think that a 0.5% cut, 0.25% cuts at November and December are likely, although the risk that they delay that one cut is there now. It really is a tough situation for the Fed because they tend to look through supply shocks, although they got burned in the pandemic by doing that to an extreme. And so they don't want to get caught into anything transitory talking as inflation maybe picks up a little bit in response to the hurricane effects. But I think the reality is that the economy is going to be on a cooling trend as we move into next year. What we've also seen and what I'm encouraged by, and this is what the Fed is going to be really looking for out there, is that productivity growth has picked up and firms have become much more nimble. We've already seen a major increase in supply chain shocks, in increased shipping costs, yet that has not shown up as passed on to consumers. The places where we did see prices accelerate, extraordinary things like egg prices, that was a real big increase. We also saw admissions to sporting events go up at a double-digit rate in the month alone. That is stunning. And so there were some of these one-offs that were very high, but overall inflation, the dispersion of the increases in inflation continues to improve, and that's something the Fed has really been watching for. So that trend is in the right direction, and the fact that we are now much more nimble than we were during the pandemic to deal with these shocks, I think is important as well.
For the market, though, Diane, they're looking ahead to the next data point because this is a data point-driven market. Will PPI show a similar trend as what CPI did today?
I think PPI will be a little different because there's different indicators in it. Airline fares were way up in the CPI. The PPI measure is different, and that's what goes into the PCE index. So there could be some real break in it. I also think what's important to look at is the next employment report, which comes out in the dark period, of course, for the Fed, November 1st, right before the election. Right now, that data is looking really, really weak. In fact, with the hurricane disruptions, with strike disruptions, and the spillover effects of all that, we could even see something close to zero or move into the red and an increase in unemployment.
But would the Fed look past that because it would be temporary/transitory?
That they won't use the word transitory. I don't think ever again.
You can't do that.
They would. Yeah. But I think they would look through it. But I do think it's important because they're going to be really reaching hard into all of their contacts, all of their regional contacts, to try to get as much anecdotal evidence as well to figure out exactly where the economy is, what's noise and what's not. And this is when it's so important that the Fed actually reaches out to their communities, because that helps them to delineate what is sort of coming out in the data and mixed signals in that, and a lot of dissonance in the overall economic data, and trying to weed through that and get an overall picture. My guess is they're going to get information that confirms that, in fact, they're not able to just pass along these price increases onto consumers, that discounting is here and that's not going away. That's the good news scenario. If they don't hear that, they will skip a rate cut.
So if Fed officials are going to look past the noise that's likely to be in the October jobs report and really rely on their on-the-ground reporting from anecdotal and whatever gets compiled into the Beige Book, how will that be communicated to the market? Are we going to then have to really parse through every Fed official's comments at every single gathering, or will there be a more formal mechanism by which to kind of relay that to everyone?
Of course we're going to go through all their statements and analyze
that's
it
separate,
and trade on it.
That's par for the course, right?
Right,
I mean,
exactly.
You can't get beyond that. And frankly, it's full employment for me, so I can't say I disagree with it. But it is important is that we're going to be parsing. I think, what really revealed, which is what we kind of already knew going into that meeting, is how close that vote was on 0.5%. And it really was a close vote. And I think it's important to remember that there were people who did not want to do 0.5%. And so they would see skipping a rate cut by year end and only getting in, sort of 0.75% instead of a full percent by year end, as well within what they sort of were thinking of going into that September meeting. And I think that's what you're going to see a lot of dissonance about as well. So this is not going to be easy for financial markets. It will be very hard communicating it. And that's because, there isn't any clear lines of sight right now. That's the hardest part of all.
All right, good stuff. Diane, always a pleasure to speak with you. Diane Swonk is chief economist over at KPMG. We've got a lot more coming up on the close. Delta clipping its outlook wings after it forecasts lackluster profit and sales that trail Wall Street estimates. We break down what's bogging the airline sales down.
Plus, as Floridians return home and assess the enormous damage left in Hurricane Milton's wake, we discuss the drastic implications of Sunshine State's real estate market.
You got it.
Hard.
And after months of waiting, Tesla's robo-taxi is finally here. We look at what to expect from Mr. Musk tonight with Tesla shares flat ahead of that event. All that and more coming up. This is The Close on Bloomberg.
What's focused now for the market is going to be earnings season, right? And so idiosyncratic opportunities for clients, that's how they've been focused, institutional clients, that's where they've been focused, that's where they should be focused. And it's a great stock picking market right now.
That was Mike Wilson, Morgan Stanley's chief U.S. equity strategist, saying there is still plenty of upside for investors who can really discern the winners and losers in today's market. S&P is down by about 0.4% and around the lows of the session. Joining us now is Mona Mahajan, senior investment strategist over at Edward Jones. Mona, always a pleasure to get your perspective. So based on what Mike Wilson was saying, Deutsche Bank also mentioned that it's cyclical growth that's going to drive equities, not rates, not inflation. Fair assessment?
Yeah, we think that is actually a pretty fair assessment because we do think that this market leadership that has started to show signs of broadening will continue for a couple of reasons. One, we do think the Fed rate cutting cycle has now finally gotten underway. That does support cyclical growth. But two, when you look at earnings, they are no longer going to be driven, especially as we get to Q4, by those handful of tech growth AI sectors. We will see a real broadening in earnings contributions from value, cyclical, and growth parts of the market. We think those two catalysts combined will lead to better cyclical growth and better broadening of market leadership as well.
We heard from Bloomberg Intelligence that analysts have been steadily ratcheting down their estimates for third quarter results, but management has been sounding fairly optimistic.
Yeah.
Why do you think there's such a big divide?
Yeah, it's a great point. And look, we came into second quarter earnings growth thinking it would be 7 to 8%. We got close to 11%. This is the natural course of earnings almost every quarter. You set the bar low and you want to beat and you want to raise. And I think the 4% number we're seeing for this quarter, probably on the lower side. So it's a good setup coming in. We think companies do have that opportunity, hopefully, to beat and raise. What we're watching really is Q4 because there's that expectation for 14% earnings growth that quarter. Everyone is hoping that that's a quarter that brings up the entire year to a double-digit number. So that's the one I think is critical.
So easy beats, but what's positioning like? Like, is it easy to add positioning at this point?
So positioning in terms of, investor portfolios right now, first of all, those investors that may be overweight cash and cash-like instruments still, I think a lot of them are starting to think about a year from now, will those same CDs and money markets be offering me the 5% plus rates? You want to start thinking about opportunities in your more traditional asset classes. So that's one momentum factor you have going for you. The second one, as we talked about, is we started to see the first half of the year was all about tech and AI. And people almost forget that because the last few weeks have been all about not tech and AI.
Yeah.
And if you are underweight that, or if you need to rebalance your portfolios, if you need to start diversifying beyond your AI and tech, and if you need to add quality investments at better prices, you may get some opportunities in the weeks ahead as well. So all of that as we're heading into year end and into 2025.
I can't believe we haven't talked about the Fed yet. I'm going to break that spell.
I mean, I kind of said like inflation and rates.
I know, but let's put that to the test, right? Okay. You had said that the rate cutting cycle is finally underway. Then we got data today that kind of complicates things. How much more does that muddy the waters here?
Yeah, look, today's CPI number, we think still on a headline basis heading in the right direction. We went from 2.5 last month, we're at 2.4% annually. Underneath the surface, we are seeing some stickier and more stickier than we'd like to see parts of inflation, including shelter and rent, including those motor vehicle insurance prices that continue to remain elevated. Food prices to some extent were elevated. We do think over time inflation will gradually get to that 2% target because we think shelter and rent cools. And we do think if the labor market, yes, it showed strength last month, but we think it's on a moderating trend overall. That means wage gains are probably going to moderate from here too, which is better or leads to better services inflation. So good overall setup, we think, for the Fed and for markets.
On the flip side, what's the reacceleration risk in terms of growth and inflation? Yeah. I mean, even today, Barkin was talking about there's a risk that lower rates actually boost housing demand. That unravels a little bit of that narrative.
Yeah, I would say right now the biggest tail risk is an acceleration or reacceleration in inflation. Because, of course, we've seen oil and energy prices over the last few weeks move higher, partly because escalation in geopolitical tensions, but also China may be reemerging. We have seen wage gains remain stickier than expected, and we have also seen parts of the CPI basket remain elevated. So we do think that if we start to see a reacceleration in global growth and combine some of these factors, the risk is really that inflation re-accelerates. Now, if it just stays steady from here, maybe it's a little bit stickier, maybe it doesn't get to 2, but it stays in this 2 to 2.5% range, that's still an okay backdrop in our mind. The re-acceleration risk is really what we want to watch for. We haven't seen signs of that yet, but if we wanted to identify one tail risk, that might be it.
Is it too early to start worrying about re-acceleration risk as embedded in each of the presidential candidates' policies that they're both promoting?
Yeah, it's a fair point because, one side seems to be promoting lower taxes, one side higher spending. So both of those have their own inherent risks to them. But as we know, enacting real policy change takes time. And we're also probably facing a divided Congress, or at least a Congress with not much margin of victory on either side, which means checks and balances remain in place and some form of gridlock is there as well. So
Congress not on board.
Yeah.
Mona, always a pleasure.
Thank you, ladies.
Mona Mahajan, Senior Investment Strategist over at Edward Jones. Now, coming up on the close, we're looking at shares of Delta. They're lagging behind today after a bumpy third quarter and a weaker than expected outlook. We'll recap all the results next in Top Calls. This is The Close on Bloomberg. It's time now for our top calls that look at some of the big movers on the back of analyst recommendations. And first up, Celsius getting a jolt of energy thanks to Stifel reiterating its buy rating. The firm encouraged by what they heard at the trade show for the National Association of Convenience Stores. Retailers are upbeat on energy drink sales in 2025, which means Celsius stands to benefit big. The price target at $51 a share. You can see Celsius surging 13% to $34.55.
I've never had a Celsius drink. All right, next in line, we got EVgo plugging in a buy rating over at UBS. Very nice. The EV charging network recently securing a $1 billion conditional loan commitment from the DOE. The analyst says this provides more visibility into the company's funding and looming expansion. They expect the loan to support nearly twice the new EV stalls as previously expected. A price target charges up to $8.50 from $4. Shares, though, down by about 4%.
And finally, Honeywell. JP Morgan downgrading the stock to neutral from overweight, but raising the price target to $235 from $225. The analyst concerned about profit margins, saying they expect the company's refreshed focus on organic growth to pay off somewhat in 2025, but it probably won't beef up the bottom line as expected. Shares down about 0.3%. And those are some of our top calls. All right, we're going to stick with the industrials here and take a look at Delta Airlines because it didn't quite stick the landing when it released its third quarter report earlier today. Adjusted EPS and fourth quarter sales outlook missing estimates, and in part for reasons due to the CrowdStrike system, outage that happened over the summer. Joining us now for more on Delta is Savanthi Syth, Managing Director over at Raymond James. Savi currently has a strong buy rating on the shares. Savi, was there anything in the outlook that suggested that this is something more structural than cyclical?
No, I think there's just some pockets of weakness here around the elections. You do have a couple of hurricanes here that are causing some noise, but generally the underlying commentary on demand was quite robust, and there were kind of pockets of weakness. I think they called out South Korea seeing some weakness, but between the capacity adjustments that the industry is making and the demand remaining healthy, I think it was a fairly upbeat call.
What I was struck by, Savi, was what they said about the election, that they're seeing sort of decreased demand because of the U.S. election, but that will sort of resolve. I don't think I've ever heard that. Is that an actual thing that happens to airlines?
It does happen every year. It's just around the election time, people tend to not to travel. It's not about kind of who wins or loses the election. It's just a matter of having some certainty. So that was not unusual. And if you look at a lot of the airlines had pulled back capacity roughly the week before and after in anticipation of that softness in demand. But it sounds like it was a lot more weaker than kind of what you've seen in the past.
I mentioned earlier about the cost tied to the CrowdStrike technology outage. Delta saying that it plans to pursue legal remedies to recover damages tied to that. Is this going to cost more than it's going to get in the end?
That's a fair point. I don't think so. I mean, like it's part of doing business, and I suspect at the end of the day, I have no insights into it, but I suspect they'll settle at the end of the day with something because these are all long-term partners. But it's definitely kind of takes the focus away from the execution in the rest of the quarter.
Has Delta right-sized its capacity? And if not, where are we in that right-sizingness?
Yeah, I think the industry as a whole is right-sizing capacity. That, we've talked about just too much capacity, especially on the kind of lower end of the market. And you're seeing some very aggressive and very close-in cuts from kind of low-cost and ultra-low-cost carriers. And what's interesting is some of the commentary is around, some of those capacity adjustments lasting for a year or two, with Southwest, at its Investor Day calling for very low single-digit growth through 2027. And so I think this industry is kind of recognizing that there's too much capacity, and they're doing the kind of hard work to adjust for that. I think there's less that Delta needed to do, but they are also going to address pocket areas that might need to adjust capacity as well.
So, Savi, this cautious outlook, relatively speaking, from Delta, how much of that is going to be a sign of what we hear from the other carriers, whether it's American, United, JetBlue, and the others? I'm not including Southwest because Southwest has its own issues.
Yeah, what I would say is, if you look at the domestic commentary, I think it's going to be somewhat positive, as was Delta's. I mean, Delta talked about domestic and transatlantic leading the way. I think you're going to hear that similarly across the board. In the Pacific, Delta called out weakness in South Korea, which they have a lot more exposure to given their joint venture partner. I don't think you're going to hear that at American or United because they have much less exposure there. So I think their Pacific performance is going to be stronger than Delta's. And then in near international, near Latin America, it seems like it's still putting pressure on Delta. And it, in the commentary from the JetBlues of the world, we've heard a much more robust kind of recovery there. So it'll be interesting to see what the commentary there is. But I suspect generally it's going to be that things are improving, especially exiting the year. And so generally a kind of a good upbeat message, if not for some kind of noise near term.
All right, Savi, thanks a lot. We really appreciate it. To be fair, I know that right-sidedness is not a word, but you still got me anyway. Thank you so much, Savi Syth, joining us over at Raymond James. It's going to be really interesting to see how the smaller carriers, like I know Southwest, like you mentioned, has its own problems, but say JetBlue and Spirit, I mean, they just can't stay competitive in the same way right now as Delta, American, United can domestically. And then, of course, international is a whole different story.
I know. I remember over the summer when they were talking about how there was going to be a decline in ticket prices. I was like, I totally don't see this.
You're like, where? Yeah. Maybe Delta.
Anecdotally from them, maybe, but not personally.
Yeah. All right. Well, coming up, Michael Levy is CEO of Pearl Holdings. He's going to talk to us about the trends he is seeing in real estate investment, plus what Fed cuts are starting to do to the market. This is The Close on Bloomberg.
It is just about 3:30 p.m. in New York. This is the countdown to the close. I'm Scarlett Fu.
And I'm Alex Steele. You're looking at a beautiful shot there of the New York skyline. Clearly a very different setup if we were to look at what's happening in Tampa as well as Florida. Hurricane Milton just battered Florida. There's still about 3 million people without power. And now the question really becomes, what's the damage assessment? That's still underway. Our next guest says that the economic impact of the storm is in the $30 to $50 billion range. Chuck Watson is president and founder of ENKI Research. ENKI designs computer models for hurricanes and other weather phenomena. He also does a ton of other stuff. But Chuck, I always appreciate having you on. I know that these events are quite straining for you and your team. Tell me how you get to that $30 to $50 billion assessment and what can change that.
Yeah, Alex, in fact, I bumped that number up a little bit because we've got a little more data. There were tornadoes, and tornadoes are kind of the wild cards in these storms. So the way it starts is we have a database of the Earth, the entire Earth. We have where buildings are, where people live, that kind of infrastructure, the economic activity, how much businesses are in different places. And then we have a model of the hurricane that then runs over that model of the Earth and tries to calculate what the impacts are, the damages from it. And so looking at Milton it was kind of a tough one in a way because it was falling apart just as it made landfall, which is great because some of the early simulations, we were looking at maybe $150 billion if it had gone at full strength down what we in Florida calls it the I-4 corridor, up Tampa, Orlando to Daytona. But it did break up. the wild card that caused us to bump the numbers up a little bit this afternoon is that, again, there were a lot more tornadoes and a bigger tornado outbreak than we were really expecting out of it.
So I'm glad
when those numbers come in.
Chuck, I'm so glad you bring up the tornadoes part of the story, because there are at least 38 reports of tornadoes that came into the U.S. Storm Prediction Center. Is this a new phenomenon where you have a deadly hurricane and then you have all these tornadoes coming in? I don't remember reading a lot about how people were anticipating these extra forces that everyone would have to contend with.
Yeah, it's interesting. And part of that is because we've gotten better at being able to look into storms. Things like Doppler radars that just didn't really, only came online about 20 years ago. And the technology, even the software, is continually upgraded. There's a new algorithm that looks for these things called mesovortexes. They're little swirls inside of storms. So these tornado alerts within hurricanes have just gotten, a lot.
Bless you.
Gosh. The alerts have gotten so much better because our technology has gotten better. The tornadoes were always there, particularly in the front right side of the storm. It's just we've gotten better at detecting them.
Okay, that's a good distinction. Chuck, are you, bless you again, are you noticing the storm any potential for it to gain speed or strength as it heads off of Florida and then turn north at all, or is the U.S. out of the woods?
Oh, gosh, there have been so many rumors about that. It's been driving me crazy with all of these emails and notes and calls. No, the storm is headed out. It's going to pass, fortunately, in between Bermuda and the Bahamas. In fact, it's already passing the Bahamas. So Milton is old news at this point, other than cleaning up the mess and tabulating the damage.
Yeah, now it's the hard work for everyone else on the ground. So, Chuck,
Exactly.
As you look ahead to the rest of hurricane season, I remember at the start of the season, it was supposed to be quite active. And then it turned out that there weren't that many named storms that were really barreling through. And then in the last couple of weeks, we really got walloped. What does this say about how we end hurricane season?
Yeah, that's a great point, and something that people kind of forget about, that, the conditions when you do the forecast at the beginning of the season are just the big picture. But then little things change during the season. For instance, we had a lot of dust and dry air come off of Africa that just completely choked off the storms in the mid-Atlantic, whereas the Gulf ended up here the last few weeks, plus the extra energy of some of these frontal systems coming through and creating low pressure systems that could take advantage of all the energy in the Gulf just happened to spin up. So it's the whole season is a complex interplay of a lot of factors, and if they line up, you get a lot of storms in a particular area, and we just can't really forecast that. How's it going to end? There's still a lot of energy in the Gulf. There's still potential for stuff to spin up around particularly Central America and do that Helene or Milton kind of tracks, but we are getting closer to winter, so hopefully those conditions are shifting more away from being favorable.
Chuck, how much damage did the U.S. incur from storms and hurricanes this season, and what was the biggest surprise for you?
For me, and we're well into we're well over 200 billion, I think, at this point. Wow. And part of the problem is we're not going to know for months, particularly Helene, because it caused so much damage from flooding in North Carolina that's still ongoing. And so that water is still draining off, and there's areas in North Carolina, and I hope that with all that's going on in Florida, people don't forget about them. They're still inaccessible areas. We here in Georgia still have areas in the middle part of the state that are severely damaged and don't have power back. So the back-to-back storms, you always worry about the people that got hit by the first storm being overlooked. But so if you look at Helene, is probably over 100 billion at this point. I don't have too much doubt about that. I don't think it's going to hit the really astronomical. I've seen 200 numbers, but it's going to be a huge impact, particularly in flood and economic disruption. Just from, you think of I-40 being closed for a year. I mean, that's a huge hit to all the economies in Tennessee, North Carolina. And then again, let's say we're looking at 60 billion, 70 billion from Milton. Don't forget Debbie, which dumped 16 inches of rain on me, which raises another point, is that one of the things we're starting to see is it seems like storms are getting wetter. Milton dumped 16 inches on St. Petersburg, which is really unusual if you look at climatology for a storm moving as quickly, because fast-moving storms aren't around long enough to dump a lot of rain, yet Milton dumped 16 inches on St. Pete. Well, that's unusual. That's well outside of what we understand climatology to be. Debbie dumped, again, 20, 30 inches on parts of South Carolina. And then Helene, of course, 20, 30 inches up in the mountains. All the way back to Harvey, we've seen a trend of much wetter storms, which, again, that's something the computer models have been predicting as a potential impact of climate change. And I think in probably another 10, 15 years, scientists are going to look back and say, yeah, those predictions from the 1990s and early 2000s that storms would get wetter and start to change, we're starting to see that. Of course, statistically, we can't say that quite yet.
Sure.
But I think in another 10 years, we'll be looking back and going, yep, that's when it started.
All right. Well, Chuck, you were there to tell us about it. Chuck Watson is ENKI Research President and founder. Thank you so much. Now, Hurricane Milton also expected to cause some short-term headwinds for the real estate sector. While investors used to consider catastrophic weather events to be one-time occurrences, analysts at BMO Capital Markets say the increased frequency of these kinds of events should be a higher priority risk for real estate investment trusts, REITs. Joining us now with his insights on the broader real estate sector is Michael Levy. He is CEO of Crow Holdings, which has about $33 billion in assets under management and is based in Dallas. Michael, thank you so much for joining us today.
Great to be here.
So I know that you heard what Chuck Watson was telling us, and I think just largely speaking, how do you think about the risk of weather events now in your work, whether you're developing or investing in real estate?
Sure. Our business is across the United States, and we're in many different states. On one hand, it's the frequency of these events. They've been with us, whether it's heat, access to water, or storms, we've been dealing with this as an industry for a long time. The most immediate consequences are in the cost of insurance, which has gone up significantly. And ultimately, that's factoring into your analytics with respect to the deal side of the business. And those insurance costs are increasing. So if they continue to increase, they will continue to put downward pressure on results. But the industry over time will adapt to that.
Does it change? I mean, you guys pretty much invest in like everything in different ways, right?
A lot of different
things.
Sure.
So does it affect kind of how you allocate your capital and where you allocate your capital?
At the end of the day in the real estate business, we're very focused on job growth and population growth and where people are moving to. And if these storms and the other heat and access to water affect where companies are moving to and people are moving to, our business will evolve in response to that. I think human beings are incredibly adaptable. And if, for example, I have friends in Asheville, North Carolina, and you talk to the people there and you know what they're going to do, they're going to rebuild.
Right.
And so I think generally, how many storms have we seen go through Florida in our lifetime and hurricanes? What's happened during our lifetime? Florida's continued to grow. Companies have moved there. People have continued to move there. Ultimately, from a risk management perspective, you're insuring. Obviously, there are some communities, some neighborhoods, some oceanfront, some beachfront where you're going to decide as an investor that you can't insure for the risk or you don't want to take the risk. Right. So, and that always happens over time. The frequency of it's increasing. It certainly has more attention, in the public domain, and the climate is evolving, the climate is changing. But we've been dealing with this for a very long time, and it continues.
You mentioned Florida and how they just rebuild every time. That is the case. But rebuilding now, as you say, brings up those insurance costs.
Sure.
And in many cases, homeowners can't find insurance at all. And
sure.
That's on an individual level. So at what point does the rebuild look different than what it had been looking like the previous 5, 10, 15 years?
I've never been surprised by after these storms that have come through that people are incredibly resilient and decide to continue on. I lived through Hurricane Sandy and everybody rebuilt. And so I'm not sure, I don't know, but I'm not sure that this storm is going to be the storm that turns everybody around. And the data, at least through today, is people have been moving to these marketplaces. True. In the Southeast and Southwest at an accelerating rate. It's like a
new Wall Street. So broader lens for your business as the Fed is embarking on a rate cutting cycle.
Yep.
Are things changing for you? Are things getting better? Yeah. Can you offload properties? Like, what are you noticing?
The market is absolutely, in the beginning of 2022, in January, when it was clear that inflation was here to stay, the market began to get uncomfortable and obviously we have the whole office sector, but in general, that malaise lasted through, I would call it May or June of this year. There was a little at the end of last year. You remember when Treasuries dropped to 3.7? There was a little bit of euphoria for a month or two. And when that spiked back up, the industry, the malaise took over. And it was clear through May or June that it felt, and you could see from a transaction perspective, people were sitting back. But at some point this summer, things changed. And the marketplace has become more liquid. Transaction volume is increasing. Investors are making more commitments. And when you look at operating fundamentals, they've remained outside the office sector incredibly strong. The headlines that I've watched over the past 2.5 years that the real estate industry is on its back has not been true. The office sector may be on its back, but the other sectors, whether it's retail, industrial, apartments, student housing, the operating fundamentals of rental growth and vacancy has gone very well. It would be great if financing costs went down. It affects the overall profitability. But nonetheless, whether they're at these rates, a little bit lower, a little bit higher, the fundamentals of the real estate industry are very strong.
Okay, so outside of the office sector, you mentioned retail, industrial, student housing. Where among those segments is the supply-demand most mismatched and therefore most opportunistic for someone?
Well, what I would say is right now, what you saw the most new supply in the past 5 years was in the multifamily sector and the industrial sector. But what's happened in the past 2 years is new starts have collapsed. New starts of industrial buildings have collapsed. New starts in multifamily have collapsed. And that means new deliveries in industrial a year from now and new deliveries in apartments 2 years from now is going to collapse. And so the opportunities, the setup for rent growth in those sectors in the next couple of years is incredibly strong.
Any location? Go ahead, sorry.
Retail also, since the early 2000s and the advent of Peapod and Webvan and all those internet themes, retail has been underinvested in terms of new supply. And over 20 years now, the new supply of retail has really come down. And so from a supply-demand fundamental, these are great times, maybe with the exception of some malls and some power centers. But in general, neighborhood retail, very little new supply, great demand. And that asset class or that sector, which has not been very attractive in general over the past 15 plus years, is becoming attractive as the office sector has now gone into a free fall with respect to its overall fundamentals.
What about warehouses and data centers and senior housing? And I know those three very different things. But the reason why I'm asking is because those are the three things that usually everyone comes on and says those are the three structural shifts in the market, like warehousing, data center, senior living.
Okay. So senior living is a very operationally intensive business. You can see the macro changing. I've been in the business 30 years, and for 30 years, people have been talking about the macro, and I've watched the industry crash multiple times.
Okay.
Right? So the supply-demand fundamentals on the micro can offset the macro, even though that's growth. It's also an operating business as much as it's real estate.
Good point.
Data centers, no doubt. Incredible demand for data centers, whether it's the hyperscalers or just general users. That's growing tremendously. At the same time, there is a wall of capital. I don't know how many trillions of dollars, but whether it's infrastructure funds, real estate investors, private equity investors, there is a wall of capital chasing the opportunity. There will be great opportunities. People will make a lot of money. But I've seen this before in my career. When so much money is chasing a finite opportunity, I'm concerned about that. But I think for the foreseeable future, data centers are going to continue to outperform if you can get the power. You saw Microsoft reopen 3 Mile Island just to get the power for a data center. And so the business in data centers is all about power today.
Yeah.
And then in terms of industrial, look, this e-commerce, onshoring, nearshoring, the demand is sustained and will continue. The supply is beginning to dwindle down. And it's a great setup for the next.
See, you got through all three, but that was good because that's where you think all the money's going to go. All right, Michael, thanks a lot. That was really great. Really appreciate it. Michael Levy, CEO of Kroll Holdings. Really insightful on all the different layers of the real estate market. All right, we are 15 minutes away from the closing bell. We'll take you through it with Drew Petit, Director of U.S. Equity Strategy over at Citi. This is The Close on Bloomberg.
I think PPI will be a little different because there's different indicators in it. Airline fares were way up in the CPI. The PPI measure is different, and that's what goes into the PCE index. So there could be some real break in it. I also think what's important to look at is the next employment report, which comes out in the dark period, of course, for the Fed, November 1st, right before the election. Right now, that data is looking really, really weak.
That was Diane Swonk, chief economist over at KPMG, kicking us off to the show. Let's take a look at where markets are, Scarlett, because we didn't get that 45th record high.
I know you've been keeping track.
I know, I do that. I also, the more I say it, the more I'll remember it. I think is to the point. We are down 0.2%, like we're kind of around the lows. But if you dig inside, it's kind of interesting. You have energy on the upside. There's some geopolitical risk being factored into the overall oil market. Airlines, though, down about 0.7% due to Delta. And one of the worst performing stocks is AMD within the movers of the day. They unveiled new chips, apparently, that disappointed in San Francisco.
Well, we're going to have a sit down with the CEO, Lisa Su, in the next hour of programming. So you'll want to stay tuned for that. But yes, it's a very interesting day given the data points that came out, both CPI and jobless claims hitting on the Fed's dual mandate. So for more on how this all factors into equities, let's welcome Drew Petit. He is Director of U.S. Equity Strategy over at Citi. So for some reason, and maybe this is just us wanting some conviction, we thought that maybe the CPI report would provide some kind of clear direction for investors and for markets.
Wait, no, the record, I said nothing. I said it would be a nothing burger yesterday. But
we were hoping. Instead, what the reports really did was just highlight the Fed's multifaceted challenge, doesn't it?
Yeah, I think it's also the market's multifaceted challenge because we're sitting there trying to hang on every macro data point and what the Fed's doing, trying to figure out where we can price this thing. But then on the flip side, we got earnings, which are just more and more disconnected from economic reality. That's just because the S&P's changed so much.
Okay, so does that mean that when we look at earnings, that's going to be the driver for the equity market, or we sort of make that idiosyncratic and we still need to look at inflation rates in the Fed?
You do need to look at inflation rates, the Fed, and interest rates because that helps you determine how much you can pay for equities. So right now we're in a little bit of a Goldilocks setup where inflation's falling, rates have come down, the yield curve is actually upward sloping or flat, which is, I guess, flat's the new up. And dollars going down and earnings growth is hanging in there. So that's all good for equity market pricing, what we can pay. But longer run, it's earnings that drive direction of markets.
And it's earnings that determine which sectors or which specific companies you look at. How low is the bar for earnings this quarter? Because analysts have been steadily ratcheting down their estimates for third quarter results, and management has been proving more optimistic.
So I absolutely love this because you hear some of the bears come in and talk about revisions are down. That's bad for markets. Guess what? Revisions are always down going into the quarter. Out year revisions are always down. The setup, though, is actually really good because the macro backdrop has been better than expected. We should actually get stronger beats this quarter than we normally get. It's not that beats are good. It's better beats than normal. And the revisions for Q4, they're probably going to be negative, but they're probably going to be less negative than they normally are.
Will the stocks move in tandem with that? So if they have a better beat than expected, does the stock move to the upside as much as we might think?
Depends where you are in the market. If you're on the growth side, probably not. I would say implicit growth expectations there are a lot higher. You need beats and raises to confirm where those stocks are priced. I think software versus long-run fundamental projections, that has the highest bar. Semis, a little bit more normal because they've kind of back and filled a little bit since, end of Q2. Then on the cyclical side, you actually have a little bit of wiggle room for some misses. We had airlines down a little bit today, but honestly, if you were a growth stock that gave a report like that, you're down a heck of a lot more.
So we're going to have pretty good visibility into what the fourth quarter is going to look like. So when those companies give their fourth quarter outlooks, it should be pretty much there. I mean, they should be able to forecast out a couple of months. But into 2025, when we have no idea what kind of government is going to be there, what administration will lead the way, what policy will look like, how much faith do you put in any of the outlooks that you do get?
Actually, we feel pretty good about 25 because there's a couple trends in the background. One, a lot of the S&P 500 companies are just better quality companies than they were 5 years ago, for example.
In what way?
Well, you basically gave them free money because they were earning more on their cash than they were paying on their debt. So they basically use that to their advantage to get better. And you can see that in operating leverage. You can see that in ROEs, and not just kind of the buyback-driven ROEs. So we feel pretty good about margins into next year. And honestly, whether we're red, blue, or somewhere in between, there are some secular trends that are still going to be in place.
Such as?
AI being one of them. Another theme that people probably don't talk a lot about, infrastructure. And I don't necessarily mean digital infrastructure.
But all this means like a CapEx cycle that's still going to be underway.
Yeah, like honestly,
right?
when we look at CapEx, we're kind of in CapEx like no cycle, which actually isn't.
Except for big tech. Big tech has been in CapEx.
Yeah, that's a little, different.
But what you're saying is that
animal.
you're going to keep spending. It's happening.
Yeah, because again, we're talking about big companies that have really good balance sheets. So it makes you a little bit less cyclical, less economic sensitive. So that's how you get kind of this like no cycle CapEx setup.
So they all have fortress balance sheets, basically, is what you're saying.
Up cap. I think down cap is where you have a little bit of the fundamental problem. That's where, like, look at how the Russell and like S&P 600 behave today. Like, that was actually ugly. You're not talking about your 45th record high on small cap. You're talking about, well, that actually outperformed for once when you see small caps work. They have fundamental headwinds. They need lower rates and an early cycle growth environment to be really structural winners.
What about mid caps?
Mid cap, see, that gets kind of interesting because they're, again, the in between.
Yeah,
mid, there
hence.
we go. But there are a lot of mid cap growth names that fall into these non-AI types of themes. That's where you can find the interesting cyclical plays tied to electrification. That's where you can find some good infrastructure stocks. That's where you can even find some of the water names, a theme that people just kind of threw out. But we think.
What's water names? What is that?
So think
not
names
utilities.
Like, not utilities, but the cyclicals like the pumps, the valves, the sanitation, the treatment, all of that infrastructure in the background. Again, cyclical, but tied to a secular trend of having to use water more efficiently. All those themes get really interesting.
You mentioned the AI story. The AI theme will still have room to play out, but it's going to look different than what it did in the first round. How does that spread to the mid cap or the small cap, or are we not there yet?
I think it'll get there. Right now, we're kind of at like the enablers phase, and we're working back in the value chain. So everyone gets the semi story. Then utilities kind of caught that bid, and then you start seeing HVAC names get picked up into that. So I think that trade is in place. We really do like the semis. We think that pullback and the expectation, like earnings expectations and revisions actually moving higher there, give you conviction. What's next? The next leg of that trade is going to be the users. So that could be the software companies properly monetizing it. That could be cyclical businesses starting to tie AI in. There's big defense companies, there's big farming companies that no longer sell you bullets and tractors, they sell you smart technologies to go with those.
I'm literally taking notes. That's what I've been doing since you've been here because it's really super smart. Before I let you go, a theme on that are utilities and power players, right? On the one hand, sensitive to rates, on the one hand, sort of defensive. On the other hand, exposed to this sort of cyclical/structural move in the AI space. What do you think of utilities?
This is actually an underweight for us and probably a contrarian call.
Okay.
Because here's the problem. We think they're going to have all these fundamental tailwinds. The market's pricing in huge upside to growth for regulated companies that can't really generate that. And then when we talk about defense, the beautiful thing about min vol is when the markets go down, it should go down less. The only time that doesn't work is when defensives are really, really expensive. Their beta goes up just like the market. So we don't think the defensives actually give you market defense. We think cyclicals and value cyclicals give you valuation defense for the market.
So smart. This was like the
Are
best
you done taking notes now?
Yeah, I'm done. I'm good.
Okay.
I'm all set. I'll send it to myself on MSG. All right, thanks so much, Drew. Really appreciate it. It was such a pleasure. Thank you so much, Drew Petit, Director of U.S. Equity Strategy over at Citi. That was like the perfect breakdown on kind of the idea of how to understand the beat and the raise and what the bar is and how that measures in to overall valuation. Another headline, guess how much into money market funds right now?
What was it before? 6.5 trillion, something like that?
Oh, well, now you spoiled it. It's 6.47 trillion.
Oh, okay.
So it keeps moving
up.
higher.
Yes.
You round it up.
And it's a record number, right?
Right, but it's a record number, and it keeps moving. We keep waiting for that money to come out. It's not.
I think you said all along that money's not coming out. People like making what they're making in interest.
I might have been talking my own book with that, but yes, I've been saying this.
All right, there you have the closing bells. You have an equity market that is in decline today, giving back some of the, or I should say, really building on what we've seen this week, which is, back and forth, adding and filling, backing and filling, and again, down 0.2% for the S&P 500. The Dow Industrial is losing about 60 points. The Nasdaq, little change at this point, off by 0.1%, and the Russell 2000, the underperformer here, losing 0.6%. After inflation data that showed prices are a little bit hotter than anticipated for the month of September, complicating the Fed's efforts to cut interest rates. So here now to help break down the market close is Bloomberg News' Vonnie Quinn, Bailey Lipschultz, and Jess Menton. It is a roundtable. Guys, welcome.
So this is a fiber, guys. I don't think we've ever done this before.
Love having you here. A lot of movement here, and certainly you got to look past the actual indexes. But Vonnie, when you look at the sector performances, what's showing up as best performers?
It's really interesting, Scarlett, because it was another choppy day, right? And there were a lot of stocks that were lower in the S&P 500, but it was really the energy stocks that performed highest in the S&P, and that's because you obviously saw WTI and Brent put on another 3.7% or so. Geopolitical risks coming to the fore again. It's not quite clear if investors are undecided what to concentrate on or if they're all taking different kinds of positions.
Yeah, and the individual stocks really much reflected that, but it felt very idiosyncratic, honestly, if you look at some of the top winners and top losers. Bailey, you get the benefit job today. You get the gainers.
The gainers, Alex. Okay, earlier in the week when I was on radio with you and Paul, I was trying to come up with an acronym for activist.
Yes, Activist Monday.
Activist Monday didn't work.
No.
So
Activist
now
Monday.
today,
Yeah, it didn't work. It failed.
We're talking about selling yourself Thursday, which is not catchy. I'm still workshopping it.
Turbo
let's
Thursday.
workshop that.
Yeah, workshop, I'll go back to the whiteboard.
On sale Thursday. Okay, go ahead.
But calling out aircraft parts maker Triumph Group said to explore a sale. We saw shares jump after that Bloomberg News report, 21%, best day since December 2023, still well below its recent highs, but shares spiking after that report, basically saying those conversations are still early on in the kind of game, but also calling out the fact that the aerospace and defense industry on the rise, deal making. You spin out companies, you acquire companies, you sop it back up within private equity and bring it up public maybe a few years later. But another company that also is said to be exploring a sale is GXO Logistics.
Oh, I see what you're doing here.
Spin-off from XPO. I only have two, though. I wish I had three. This coming after Bloomberg also breaking news that the company is said to explore potentially selling itself. We saw a couple actual banks coming out saying this could be a company that would be acquired potentially by private equity, just given the logistics space. Again, I think it's kind of funny that you get spun out and then you end up getting acquired by private equity. It feels like only the bankers and lawyers really make money on
That's kind of the consistent truth of Wall Street, right?
But that's keeps going. And one fun one, not sales related, is Celsius, the energy drink maker, rallying the most since February. This coming after Stifel positive note on convenience store outlooks. So energy drinks, Celsius, Monster. People are buying energy drinks when they go running errands, pit stop to get gas. Why not go get something that probably makes your heart beat way too quick?
Also, it's midterm season for college students, so you got to chug that Celsius.
Wait, midterms already?
Yeah. Well, my son's taking his midterms. So.
Oh my gosh,
Yeah.
I've never had one of those. I'm totally scared.
A midterm or a Celsius?
No, Celsius. Definitely had midterms. Although, to be fair, it was a long time ago. All right, decliners. Jess, it's all on you.
Unfortunately, I have the losers for today, but I'll have to point out what's happening with solar stocks because they're the top two worst decliners in the S&P 500 on a percent basis. So what happened here? First Solar dropping 9%. It's its worst day since June 28th earlier this year. Jefferies, unfortunately, it cut its price target on the stock from $271 to $266. They still have a buy rating on the stock, though, but they are concerned about the short-term effect of where the outlook is for how much more that stock is headed. If you look at TAN, that's the ETF that tracks the solar stocks in the S&P 500. That was also lower today, too, when you're looking at that. Also, Sunrun down almost 7%. Worst day since September 3rd. Enphase Energy, another company in that space, also getting pressured, just given the downgrade there. Then I want to move over, of course, we always have to talk about what's happening in the chip space because I wanted to bring up what's happening with AMD in particular, because obviously this is another bellwether when you are looking at that corner of the market. Down about 4%, worst day since September 3rd. And it's interesting because they actually have an event right now related to AI in San Francisco. They were rolling out what they're trying to compete with when it comes to NVIDIA and the Blackwell type chip. So they have a new one that's coming out, an MI325X update, new version for this is supposed to be out in the fourth quarter of this year. Then they have some other updates that are going to be happening next year as well. But what's interesting is this stock in particular over the past month has been up close to about 14%. So it may have kind of front run and outperformed some of the other chip makers. So that's why it might be kind of a sell the news moment. But wanted to bring up NVIDIA because right now with its latest gains today, it's actually only about 0.6% off of that all-time high that we would have seen back in June. And that was right when it had the stock split and started coming back in. in a little bit. So you are seeing NVIDIA come back here and could potentially, propel the
You snuck a gainer in there.
Yeah, I did. I had to kind of compliment it with something with that, some positivity there.
That's fair enough. I just want to hit on the bond market, guys, real quick. So it was a kind of bizarre day in the bond market because it was digesting that CPI data, right? You had initial jobless claims rising more than expected. Then you had that disinflation narrative kind of off the table when it comes to inflation. That was reflected in the bond market. You saw buying in the front end, selling in the back end. We had the 30-year auction, which actually went pretty okay. And just in these last few moments have we seen that 10-year kind of turn around and now ending the day flat. But nonetheless, it's still a steeper curve in the world. But, it's like, how are we leading it? What's leading that steeper curve that I feel like is the head scratcher?
And when it comes down to it, not a whole lot of movement except at the very short end, right? The 2-year moving down 5 basis points, but you look at the 10-year and the 20-year, it's like nothing.
Yeah, now, yeah.
All right, so one of the stories that we're paying attention to, of course, has to do with inflation. And I thought it was really interesting that there are a lot of fine dining restaurants that are no longer sharing details like their menu or how much things cost. And these are hot restaurants. What? And the idea is that you just have to trust the chef. Like, they're a big name restaurant, so just come in and trust us, not put blindfold on, but essentially go in and we will serve you and you will eat what we serve you and you'll enjoy it.
I feel like I always end up being disappointed if I feel like I didn't get enough food. If it's one of those, there's multiple course meals, and then afterwards I feel like, okay, I'm still hungry and I want to go up and get something else. So sometimes I'm a little skeptical if I can't look at the menu.
Well, the one thing that can be difficult about it is if you don't know what you're going to be paying in advance.
Exactly.
There's no prices. But the funny thing is the more expensive it is, the more I'm quite happy to let them decide everything for me. And if I know nothing about it, then I'm almost happier. If it's a cheaper restaurant, I sort of want to have a look beforehand, perhaps, to see what's on the menu and what the decor is like.
You're mentally prepared to just spend a lot of money.
See, I'll eat anything, but to that point, when I say market price, I always am so is that a market price with 2 figures, or are we talking 3?
Just give me the ballpark.
Really, give me a guesstimate. Just keep it in a
Tell me the number of digits here.
Yeah, exactly.
Well, here was a fun one. Well, maybe not. So I'm a homeowner, right? So I have a different perspective with this. But apparently, when you take a look at New York City rents, they've come down, and I put it in quotes because I feel like the median is still $4,200 a month, and I have no idea what you're getting for something like that.
All I know, Alex, is that your interest rate is far lower than mine is. What is it again?
Bailey is like a new homeowner.
What's yours again?
7 and an 8.
I'm so sorry.
I'm going to refi. I'm talking refi.
He's working on it.
Wait until a 5 handle. Don't refi yet.
Oh, that's my strategy. But then I saw rates pop back up by
No, they're going to go down. Do not refi with a 6 handle. That is crazy. But I think my point is that if you have structural issue when it comes to housing, it's going to be hard to see how rents materially come down.
Well, I'm a millennial, so luckily somehow I was able to score a rent-stabilized apartment, but it took years in order to get that there. So
you're never moving, are you?
No, probably not. But they're trying to push us out. They shut off our gas for at one point last year. I think they're trying to work this, but I'm not going to go down without a fight.
Such a New York story. Don't we all know somebody in a rent-stabilized place?
I live in a rent-stabilized apartment. I was hoping it was going to be those one that's goes condo and I get it for $100,000 and I get to sell it for $8,000.
Exactly. So I have to let this go out and try to hope for the best here.
Anyone else moving out of your building?
I know everybody.
No, you want to pay more. Go for it.
That's such a New York approach, right? All right. Thank you to everyone involved. Bailey Lipschultz, Jess Menton. Alex Steele, you're taking off. Thank you for taking us through the closing bell. Vonnie Quinn stays with us. And coming up in the next hour, AMD CEO Lisa Su sits down with Bloomberg's Ed Ludlow to discuss the unveiling of their newest chip. This is The Close on Bloomberg. Welcome back to The Close. I'm Scarlett Fu.
And I'm Vonnie Quinn. And Scarlett, let's take a look at where those markets closed out the day. We have the S&P 500 still very close to its record, but down 0.2% in today's session, just 12 points. It was a pretty choppy session. We were actually positive there for a second around midday, but we, again, down 11 points at the finish. Most sectors were lower. We did have some energy companies higher off the back of crude oil rising, and also a few information technology companies and just the odd company here and there higher. And to that, I wanted to point out the Philadelphia Semiconductor Index, because most of the stocks there were down. A very choppy week for the semiconductors. AMD, for example, the worst performer in the stocks, but NVIDIA continued with its rally. Now, we did have a little blip yesterday with NVIDIA down just very slightly, but it resumed its rally. It's up something like, I would say, 13.5% at this point in the last 7 sessions. The 10-year yield was the one that moved more than the 2-year yield. At one point we were at 4.10. Now we're back up to 4.06. That curve steepening. And then again, crude. We are just barely below $76 a barrel. Right now the Israeli Security Council is meeting, and we will bring you any news that we get out of that, should we get any. Scarlett.
All right, let's follow on some of the sectors that you mentioned and take a look at AMD, down 4% on the day after unveiling new chips at an event, which they say will exceed some of the capabilities of rival NVIDIA's chips. We will have a sit down with AMD's CEO Lisa Su later in the hour. Meantime, Vonnie mentioned energy stocks. XLE is the ETF that tracks those big cap energy names, higher by 0.7%, but it's really the trend over the last 10 days or so. The stock, the ETF, I should say, has gained for 9 days out of the last 10. And of course, getting a big helping hand from the rise in oil prices, even though their earnings prospects have dimmed. According to Bloomberg Intelligence, analysts now anticipate a 23% drop in third quarter earnings for the energy sector in their profits. That is more than 4 times the decline expected just 3 months ago. So those estimates have been coming down fairly rapidly. And that brings me to our top story this hour. Look for a rare earnings split in the third quarter results. According to Bloomberg Intelligence, analysts keep lowering the bar for S&P 500 companies' earnings, while their management's guidance implies a stronger outlook. That is a sign that companies should easily top estimates when they do report. Earnings season kicks off tomorrow before the market opens, when the big banks publish their results in the morning. Bonnie?
Scarlett, that's absolutely right. JP Morgan and Wells Fargo set to report tomorrow morning. And our next guest writes that it's a, quote, slow but stable operating environment for the banks. Chris Kotowski, Managing Director and Senior Analyst at Oppenheimer, joins us now. So, Chris, I feel like for the last several quarters, we've been looking for, a fairly plain vanilla quarter maybe from each bank. And we've got surprises along the way. If it's supposed to be a plain vanilla quarter this quarter, then what surprises should we expect?
Well, I mean, for the most part, you've gotten pretty stable results. And, if you think about it, it's extraordinary. You had a 500 basis point increase in rates in late 2022 and early 23. And you kind of would have thought maybe the economy would slam on the brakes. And that didn't happen. What happened is the American corporations and consumers, they kind of lifted their foot off the gas, but they didn't slam on the brakes. And so what you've seen throughout is that loan growth is very slow. It's like 2%, but it's positive, right? And it's not like all of a sudden corporations are trimming inventories and laying off people or anything like that. So it has, for the most part, for the big banks at least, been reasonably stable and steady. There was, of course, a flurry of concern after the failure of Silicon Valley, right? And who's next and all that. But there are many reasons to think that was an outlier. And if you look at the big banks, for the most part, they benefited greatly from that increase in rates. On average, there was like roughly a 30% increase in the net interest income from the banking system. And then we gave back about 8% of that. But we're still in a much better place than we were a couple of years ago.
So when it comes down to it, when you're looking at the results for the third quarter, what do you think will be more revealing at the end of the day? The bread and butter lending business that you mentioned, or capital markets performance?
Well, the capital markets performance, I think, is still on the come. I mean, if you look at the key items, there are equity underwriting and M&A, right? Those are the kind of key sentiment indicators. They're still down, 20% plus from 2018 and 19. And if you think about it, it's extraordinary because nominal GDP is more than a third higher. So if in relation to the real economy, it's like really slow still. And, and I still think that's on the come. In addition to the banks, I also cover a lot of the alternative asset managers like Blackstone and KKR and so on. And, they have a lot of dry powder. They have a lot of companies that they've owned for a long time that they're looking to sell at some point. And, the rate environment is stable now. I don't think rates need to go down a lot. As long as they don't go up, I think then people can start planning on, okay, this is the cost of capital, and I think the economy is mainly adjusted to that.
So 2 slices of life tomorrow with Wells Fargo and JP Morgan. I have to ask the stock question. JP Morgan up 25% year to date, Wells Fargo up 17%. Are the gains in, even if we see relatively okay results?
What do you mean the gains in?
Do we go higher?
So if you look at the group overall, and I've stopped comparing it to the S&P 500 because the S&P 500 multiple just keeps on going up and up and up.
Thanks to tech, yeah.
Thanks to tech. And so we've started comparing it to the equal-weighted S&P 500, which is like 26 percentage points cheaper than the S&P, than the regular S&P. And if you look at it based on that, banks are currently around 67% relative PE to the equal-weighted, and their 10-year average is about 73. So they're still a little cheap. They're not dramatically cheap, but they're still a little cheap, and I think it's an okay place to be. And neither of those two would be my favorites. I personally think the best play for the next 6 months would be the investment banking-oriented names, Goldman, Jefferies, and that's because I still think that rebound in capital markets is in front of us.
Interesting.
Rather than behind us.
So the other thing we want to watch for is after the big banks report the results is a borrowing binge. According to JP Morgan, the 6 biggest banks will borrow anywhere from 20 to 24 billion after they post results. How do you read into this? I mean, that's going to be more than the 15 billion they've raised in previous Octobers over the last decade. Is there something more to this, or is this just a case of them being opportunistic about raising money?
It's probably a combination of that, and remember also the regulators have just been pushing capital and liquidity, and as I said, I cover the alternative asset managers, and as a result of kind of the regulators' restrictive view on banks and the costs they put on the banks, the credit markets there are ripping and roaring, and the banks are doing a lot of things just to satisfy their regulators. So I'm not sure that there's anything fundamental to read into that.
All right, fantastic. Chris, always a pleasure. Thank you so much for joining us on the eve of bank earnings.
Great, thank you for having me.
Chris Kotowski is Managing Director and Senior Analyst at Oppenheimer. Coming up, we've got the top three movers and shakers at the center of the day's big stories. This is The Close on Bloomberg. Everyone has an opinion on the FTC chair, Lina Khan. Traders, investors, CEOs, and politicians. She is the subject of this week's Big Take. The youngest ever FTC chair has toughened merger oversight and taken on non-competes, among other things. And now she's hinting there's more to come if she gets another term. Bloomberg Businessweek's Max Chafkin joins us now. And that is a big if. And there's been a lot of fighting words around, her fate. AOC recently made some comments saying there's going to be a brawl if Kamala Harris decides to remove Lina Khan.
Yeah, and this is some inter-Democratic Party sort of back and forth, because Mark Cuban earlier had essentially criticized Lina Khan. AOC coming out saying, no, I don't think so, Mark Cuban. So what's happening is Lina Khan is extremely polarizing. You're seeing essentially the parts of the left and parts of the right kind of being behind her, and then sort of the middle of the political spectrum, which includes a lot of business folks, feeling very aggrieved, feeling like she has gone too far, is quashing too many mergers, has been too friendly to unions, and so on. And it's kind of an interesting political moment.
Well, there's been an interesting development among conservatives, right? Especially Silicon Valley conservatives, who many of them now see the big tech companies as the enemy.
Right, and Lina Khan kind of splits that group to some extent. So you have a lot of people in Silicon Valley very mad at the Biden administration over crypto because of Gary Gensler, and then there's another contingent that's mad because they feel like they can't get deals done, and that is the Lina Khan. Those are the people who are angry at Lina Khan. They feel like by stopping a handful of these big mergers, or trying to stop in some cases, she has made it harder for VCs to get exits. As one VC put it, she's breaking the venture capital business. There's another issue, which is that she has not taken the tone that they would especially like, and she's kind of come to embody something that they perceive about the Biden administration as a whole, which is that it's been more hostile, less willing to kind of, kowtow or sort of contort itself to fit their interests than past administrations. And we've seen that on the Trump side as well, right? Trump going around saying he's going to jail Mark Zuckerberg. So there's a feeling in parts of Silicon Valley, right, that they had a lot of purchase in Washington, and now they don't anymore.
Right. What is Lina Khan's backstory here? I mean, what's her philosophy be guiding her as she, comes through as this very tough FTC chair that, this agency, let's face it, was kind of, all bark and no bite.
Super interesting backstory. So she is often described as an academic, but that kind of misses it because she was really a law student before she became the FTC chair. Yeah. And she became famous for writing this paper while she was in law school that essentially argued that Amazon was an illegal monopoly. And in the past, regulators had looked at Amazon and said, low prices, that's good. Lina Khan says, no, we got to look closer at that. You got to see the impact on businesses, small businesses, of course, which have complained about Amazon, workers, and even consumers. And so she brought this whole new way of looking at antitrust that has been applicable in a world where they have these big tech platforms, which often have low prices or even free products, but imposed other costs on society.
Same background as J.D. Vance, no less.
Yeah,
to an extent.
Yale Law, and J.D. Vance, strangely, even though she's a Democrat, even though she's beloved by members of the squad, by AOC, J.D. Vance has praised her. So she does create this interesting wedge politically, and because of that, it's very hard to know what would happen. I think if Trump is elected, it's very likely he would try to appoint his own FTC chair, but I don't know that that person is going to pursue policies that are as radically different from what Lina Khan does than some would hope.
When you're very far right or very far left, sometimes the two end up meeting, because it's a circle. Max Chafkin of Bloomberg Businessweek, thank you so much.
Thanks, Fab.
Great story in Businessweek about Lina Khan, and it is our big take today. All right, let's move on now to our top three, where we name drop the people driving some of the day's most talked about stories. And first up is Rafael Nadal, the tennis legend retiring at the end of the season. He says he will hang up his racket after next month's Davis Cup finals. He's won 22 Grand Slam titles, 14 at the French Open.
Isn't it insane? And even with all of that, he's only the second biggest earner of all time. Isn't that insane, Scarlett? A massive amount of money. And when it comes to what he's going to do next, well, he is going to continue playing, at least for now. He's off to Saudi Arabia in a few weeks to play a big tournament. And he's also going to be competing against Djokovic in that. So it's not the end of the Djokovic-Nadal
rivalry. Yeah.
But, maybe he'll start some kind of a company and we can have him in.
I have no doubts that he's going to move on to do something like that. All right, who are you watching?
Well, I was watching Taylor Swift because she donated another $5 million. And of course, she is fantastic at doing this. But when it came to the hurricane, she donated another $5 million to Feeding America. And goodness knows all of the states that are hit by the hurricane need it.
And by the way, she's hoping to perform in Florida next week, too. The Eras Tour still going on. It's scheduled to begin at Miami Gardens on October 18th. So
yeah, let's hope it can go ahead.
All right, rounding out the top three is Ethel Kennedy, the widow of Robert F. Kennedy. She's died at age 96 from complications related to a stroke. You know how people say behind every successful man, there's a woman supporting him?
Yes.
Ethel Kennedy.
She is the embodiment of that. And I have to point out that apparently Starlight from Taylor Swift's album Red back in 2012 is about Ethel's relationship with Robert F. Kennedy. Isn't that incredible?
Interesting.
With Bobby Kennedy, yeah.
Well, she became a widow at age 40, and she has moved on to do incredible things. A big philanthropist, and obviously her family is, such a stalwart in Democratic politics.
11 children. Can you believe that? And basically all on her own, along with her maid and her, constant companion for those years that managed to help her bring those kids up as well.
All right, rest in peace, Ethel Kennedy, passing away at the age of 96.
In just a few hours, Elon Musk will unveil Tesla's autonomous taxi prototypes. Though Tesla has kept the final design of the robo-taxi under wraps, the car is expected to have 2 front seats and 2 butterfly doors in the back. This comes as we near the anniversary of Tesla's Cybertruck delivery event. Joining us now with what more we can expect from tonight's event is Bloomberg's Dana Hull, who covers Tesla and Musk. Dana, you've seen a few of these unveilings. Should we expect any surprises tonight?
Oh, for sure. I mean, the expectations are so high for the company, given the run-up in the stock since they announced that they were unveiling a robotaxi, that I think there's got to be a one more thing, or the announcement that, FSD is expanding to other locations. I mean, they've got to do something besides just show off a vehicle. They've got to give people rides, too.
Okay, so what are we likely to hear from Musk? What are we likely to not get? Because there's going to be a lot of generalities and promises made, but maybe not a whole lot of details.
Well, we don't really, the truth is that we don't really know. I mean, what Ed and I have reported is that we are expecting to see a vehicle that has two kind of butterfly wing doors that open up. I would expect to see more than one vehicle. I think that part of the reason why this event was delayed from August to October is that they want to have several vehicles on site at this event so that investors and analysts can get rides in them. I expect that we'll probably see Optimus, the robot, make some kind of an appearance. We're going to hear Elon talk about AI. And then there's the whole question of FSD Supervise, which is the software that Tesla customers can currently buy, and some progress on that.
Yeah, I mean, it's fascinating. It was Elon himself, apparently, according to your reporting and Ed's reporting, that put this off because he wanted other things done, or at least that's what he said. Dana, you point out in your most recent story that NVIDIA trades at 36 times forward earnings. Tesla is actually trading at 83 times forward earnings, which seems insane, but to some extent, it almost doesn't matter, right? This is just a key man risk type company, and if Elon is still in investors' good books, then they'll keep buying the stock, except for today.
Well, I just think that it's important for people to realize what's happening globally. I mean, there is huge interest in autonomy, particularly in China. And, as electric vehicles become more commonplace and every other automaker is now making an electric vehicle, Tesla wants to differentiate itself. And going full in on autonomy is a way to kind of keep that tech multiple for the firm.
Dana, Vonnie had mentioned that this comes as we get closer to the anniversary of the Cybertruck event, the delivery event. And that has not been a real game changer for Tesla in terms of really moving the needle on sales or profit. Are we anticipating that at some point the robotaxi will do just that? Or is it going to be, one of those things that it spends a lot of money on and is a leader in the space, but, may not really show up in the bottom line?
Well, the Cybertruck event was similar. I mean, the event that you're referring to where they shattered the glass, that was similar. That was an unveiling. It wasn't a delivery event. But yeah, it usually takes a long time for these things to actually get into the market in high volume production. I mean, we know that Tesla is still not delivering that many Cybertrucks. I do see more and more of them around, but it's nowhere near Ford F-150 volumes by any stretch. But I think it's all about Tesla investors tend to be pretty long term. I mean, they are in this for where is the company going to be 10 years from now, 5 years from now? It's not the type of trade that short-term people are really in. And, if you believe Elon, you believe that he'll eventually get there.
All right, good stuff. Dana, thank you so much. Dana Hull of Bloomberg News, who covers Tesla and Elon Musk ahead of this evening's robo-taxi event, the unveiling. It's happening at 7 p.m. Pacific time, Vonnie, 10 p.m. New York time.
Yes, it's something that, a lot of people will wait up for. I'm not sure I will.
Musk superfans in particular. All right, let's take a look at how markets closed on the day. We had a decline here in the S&P 500, Dow, and NASDAQ, in fact. And this is as inflation data came out that showed prices are still rising and kind of moving in the wrong direction, certainly as given the disinflation narrative that's really taken hold.
Certainly for things like food and goods and so on, Scarlett. But I tell you, the Fed will have taken some heart out of the fact that shelter costs did come down in that inflation figure. So while overall inflation did go up, the part that was most mystifying to the Fed, and Jerome Powell said this at the last FOMC meeting, was the shelter costs weren't going down, and they did in this particular report.
And NYMEX crude moving up by more than 3%. Traders remain on edge, waiting for some kind of response to the Iran missile attacks. This is the close on Bloomberg.
Millions of Floridians are assessing the damage put forth by Hurricane Milton after the storm barreled across the state, causing widespread flooding and destroying hundreds of homes. The Florida State Board of Administration said it expects a quick and solid rebuilding process for residents with flood and hurricane insurance. Bloomberg surveillance hosts Jonathan Ferro and Lisa Abramowitz caught up with him earlier this morning. It's part of today's Muni Moment.
Florida carries insurance. In the case of the state of North Carolina, Asheville alone only had 248 flood policies. But most people would think, why do I need to have flood insurance while I live in North Carolina. So in the case of the state of Florida, we're much better covered. We have much more of an insurance blanket over the state of Florida. So again, there will be challenges, there will be rebuilding, but to me, nobody does recovery better than the state of Florida. And this is what we'll do. We will take one foot in front of the other, and we'll continue to build back our cities and our communities.
Jimmy, of course, there will be some residents worried about their property taxes, worried about their finances. With the experience of Hurricane Ian, can you just walk us through, for the people who aren't aware of this, how the rebate system actually works down in Florida?
Well, I think the reality that people have to let sink in is look, it costs more per square foot to build a house today than it did 5 years ago. So the cost of construction is going to change when it comes. So some people will be underinsured. Some people will sell their homes as is. They'll cash out. They'll move into another community. When Hurricane Michael hit my hometown, my neighborhood, everybody had aged out. So what a lot of them did is they cashed out, took their money, and they moved closer to their grandkids or their kids. So again, this will be some of the similar type of response we'll have of this. St. Lucie County, where one of the tornadoes hit, was a retirement community. I'm sure a number of those families will probably look at other alternatives as they receive a large payout from their insurance company, and they may just decide to pick a different place to live closer to family.
Jimmy, do you think that just in general, there is going to be kind of a migration in Florida away from some of these areas that have gotten hit, as you said, as people age out, decide to shift elsewhere?
On the contrary, it's amazing the type of land rush that takes place after a storm. You will have all of those that saying, you know what, again, I've aged out, I'm gonna move out, but there are people lined up down the street and around the corner that will buy back in those coastal communities. They will build up, they'll build to the higher building codes, and they will make the necessary investments to be able to enjoy what's beautiful about living on the Gulf Coast or the Atlantic coast. But you would think that, but it's amazing the type of land rush that happens immediately after a storm.
And that was the Bloomberg surveillance team speaking with the Florida State Board of Administration's CFO, Jimmy Patronis. Our next guest weighing in on this hurricane season, writing, it may still end up being a fairly normal season in terms of quantity, but on a heating planet, normal is increasingly dangerous. Mark Gongloff of Bloomberg Opinion joins us now. And Mark, thank you so much for taking the time. It's clear that there's no such thing as normal anymore when it comes to the hurricane season or even a normal storm, not when everything seems to qualify as a once in a generation or once every 1,000-year storms. And they develop super quickly and are often back to back. How are you thinking about this as you kind of tally up the costs of everything?
Yeah, the difference between storm seasons now and storm seasons, say, 20, 30 years ago is you don't see more hurricanes than usual because of climate change. What you do see is that when the conditions are right for hurricanes, the storms tend to be supercharged. We've seen it at least 3 times this year with Beryl, which hit Texas really hard, and then Helene and Milton, back-to-back storms. All 3 of them spun up really fast, got really strong, really big, and dumped a whole bunch of water in a lot of places. And that makes these storms much more destructive. It makes them riskier in terms of lives. We lost a lot of lives in Helene. Fortunately, it doesn't seem to be too bad after Milton, but the level of destruction could still be pretty high there too, just because of the sheer amount of energy that these storms are putting out now.
And Mark, as you point out in your column, they're hitting places you never would have thought were vulnerable, like Appalachia, for example. Is that now what we can look forward to for the rest of the season? Because after all, you know, we're going from an El Nino into a La Nina, and that's what usually happens.
Well, hopefully the season will start to calm down a little bit. I mean, one of the interesting things about this season is, in terms of raw numbers of hurricanes, people expected it to be very high because of La Nina and because the ocean waters are at record highs. They thought that those 2 factors would combine to produce a bunch of hurricanes. La Nina didn't show up for a long time, and it's only barely started. And that's one issue that's like tamped down on the number of hurricanes. And we are getting late in the season. Typically, right around now is when we get sort of a second peak, but it's really going down until the end of November. So we may not see more of these monsters. There's nothing on the map right now, but we should see some more hurricanes. But again, you know, the issue is that they are going to, when they do again show up, they do reach places, as you say, like Appalachia, Asheville, North Carolina. A lot of people considered that a climate haven. And in fact, there were a lot of climate scientists living there. There's a weather station there with a bunch of data that was shut down for weeks because of the storm. And so a lot of people were taken by surprise by this storm, and we have to rethink what a haven means to us.
Well, let's hope we've seen the worst of it for this year. Mark, your opinion column's always a fascinating read. Mark Gongloff there of Bloomberg Opinion. This is Bloomberg.
From robo-taxis to AI chips, Bloomberg's Ed Ludlow is standing by with Advanced Micro Devices CEO Lisa Su, who joins him live from AMD's Advancing AI event in California, where they just unveiled their latest generation of chips. Ed?
That's right, Scarlett. And Lisa Su celebrating 10 years as CEO of AMD. Lisa, MI325X. Everyone I speak to in the world of technology accepts and sees that AMD is the number 2 rival behind NVIDIA. How does the latest accelerator change that competitive landscape in that market?
Well, first of all, Ed, it's great to be here with you today. Thank you for having us. It was a big day for us. We talked about so many new technologies. We launched a number of new products. We launched our new 5th gen EPYC server product called Turin. We launched MI325 and talked about our future roadmap and MI350 and beyond. We talked about AI PCs and networking. So it's been a great day. As it relates to, MI325 and what we're doing in the data center accelerator market, I mean, this is such an exciting market right now. There's so much demand overall for new AI capability. And, we are doing extremely well. We had a number of customers on stage with us today, too, including Microsoft, Meta, Oracle, a number of new, AI companies, as well as all of the major OEMs. And everyone is excited about MI325 and the roadmap ahead.
And yet, shares closed down 4%. The disappointment is not in the long term, right? You updated the forecast for the market, $500 billion in 2028. But what can you tell me, or how can you quantify the near-term demand of those new customers that you just outlined?
Well, the best thing to say, Ed, is this is an incredibly fast-growing market. I mean, if you think about, what we've done just over the last 12 months or so, we've seen MI300 demand increase from when we started the year to, in our most recent earnings, we actually said we would be over $4.5 billion in this important AI accelerator market. We view this as a multi-year opportunity for us. And what's really important, what our customers say is, we've shown that we have excellent hardware, but even more importantly, we've made tremendous progress in the overall software roadmap. And what that allows customers to get to market, as fast as possible. So we're seeing, with MI325, we expect the new chips to be anywhere from 20 to 40% higher performance on key inferencing workloads than the competition. And that's a great place to be.
Lisa, describe the demand for your AI products in just a single word.
Amazing.
Give me more than that. How is this different to a year ago? You remember us sitting in San Jose, right? We were sitting together, and it was the start of a very different time in the investment cycle. How is it different now?
Well, I think, so in a single word, the best thing to say is it's an accelerating market. And, what we see is so many new applications, so many new opportunities to use AI. We're at the very beginning of the cycle. And one of the things that I've been very, very encouraged at is, when we started maybe 12 months ago, you would see that, there would be a lot of people trying things, but it would actually take them a while to cut over to their production environment. That's actually much faster now. And what that means is, there's more demand for AI capability, but we've also significantly improved our tools and overall software infrastructure. We call our software suite something called ROCm. And it has just made tremendous progress over the last 10, 11 months that really allows customers to adopt our solutions, much, much faster. And that's the key for innovation, is to try to get as much in as fast as possible.
And CPU as well. If you're an investor on Wall Street, or you are a retail investor, or you're a technologist, or dare I say it, a technology journalist, everyone is so over-indexed to GPU. I really want to know if you see a sort of revision back towards emphasis on CPU with all of the data center investment and build out that is to come?
I think the most important thing to think about, Ed, when you think about data center infrastructure, is there is no one size fits all in computing. You need great CPUs, you need great GPUs, you need to be able to bring those together in systems. You need to have all these different types of computes. You need to have, frankly, AI PCs is another category that we find to be a very interesting and exciting category. So when you put all those things together, first of all, we're super excited about our new generation of EPYC servers. This is our 5th generation we call Turin. We've seen tremendous performance. In many cases, our performance over the competition has increased substantially with this new generation. And what CIOs are telling me is they're looking to modernize their data centers. The idea of, there's a lot of data center infrastructure out there that is, 3, 4, or 5 years old. Those guys are not as performant. They take up a lot of space, and frankly, they cost a lot from an operational standpoint. And so we're able to substantially modernize the data center by adopting our new generation of EPYC CPUs. We're seeing anywhere from a 7-to-1 ratio. You can replace 7 legacy servers with a single new, Turin 5th generation EPYC server, and that just results in tremendous, payback for enterprises.
Lisa, this is a question from our Bloomberg Technology audience, direct. Would you consider using Intel for Foundry?
Well, look, when we look at the manufacturing landscape for semiconductors, it's really important to have, a strong manufacturing set of partners. We're extremely happy with the work that we do with TSMC. They're a great partner. It is also super important for us to have geographic diversity. I think what the CHIPS Act has done has been excellent in terms of trying to bring more manufacturing back to the U.S. We're excited about the work that's being done in Arizona, and we're very active in bringing some of our chips into the new factories of TSMC in Arizona. And we're always looking at the manufacturing landscape, and we'll always think about how we can have the most resilient supply chain.
Lisa, for the last month, Bloomberg's Ian King and I have been using AI PCs with processors based on ARM architecture. I feel like the gap with x86 is closing. When does AMD wade into that arena?
Well, I need to send you an AI PC, Ed, that's for sure.
Please.
So, look, AI PCs are an exciting new category. It really will change the way the PC form factor, behaves, especially for enterprises. When you think about, all of the business productivity, all the collaboration we do, all the security that you need, AI PCs really fits that. We just announced that we'll have Copilot Plus enterprise PCs with our new Strix, Ryzen AI capability. We had Microsoft on stage to talk about some of the new experiences there.
Yes.
You'll see plenty of AI PCs from AMD this year, and that even increases as we go into 2025. So over 100 plus enterprise platforms with best-in-class AI capability.
Lisa, let's end the conversation looking to the future. You've celebrated 10 years. A year ago, you set out aggressive targets for your company and the industry. You sat next to me and outlined them. Where do you go next?
Well, I would say, first of all, this is an incredibly exciting time to be in the industry. When I think about what we have in front of us, the promise of AI, the fact that high performance computing is, at the center of everything in the world, and we're able to really use the technology for good, that's super exciting for me. And then we have this humongous opportunity when you think about AI overall, and AMD is the only one in the industry that can really bring together all of these end-to-end AI pieces. So it's a super exciting time, and I'm really looking forward. I'd like to say we're just getting started.
AMD CEO Lisa Su, thank you for your time. Scarlett, Vonnie.
All right, thank you so much. Ed Ludlow speaking with the CEO of Advanced Micro Devices, Lisa Su, as they unveiled their latest chip, which is meant to compete against NVIDIA's new generation chip, Blackwell. All right, Vonnie, let's look ahead to what else we're focusing on over the next 24 hours. Things begin tonight with Game 1 of the WNBA Finals. We're going to watch the New York Liberty versus the Minnesota Lynx. The Liberty lost in the finals last year to the Vegas Aces.
It's going to be so exciting. Can you believe that even though both of these teams have made it to the finals on separate occasions 7 and 6 times, they have never met So they have to have this amazing game tonight. I would give anything to be at the Barclays Center. It
Lots of drama.
Incredible. And then, of course, big data tomorrow, Scarlett. We're going to get, obviously, PPI, University of Michigan, and, of course, bank earnings. JP Morgan and Wells Fargo spoke with Chris Kotowski earlier about that.
Yeah, and, of course, we're going to be watching for what they say in terms of their outlook for net interest income. Certainly, they saw benefit in that when interest rates were going up. So how does that now change with the new interest rate environment and the Fed on this rate cut campaign? And, of course, that only just begins the earnings for the banks, because on Tuesday, next week, we're going to hear from Bank of America, Citi, Goldman, Charles Schwab, and Morgan Stanley on Wednesday, and then you have the regional banks that report too.
The dawn of a new quarter, and we're going to get more Fed speak as well tomorrow. Of course, we're going to be hearing from Austin Goolsbee. We already heard from him a little bit today, but one of the other events that's happening this week is, of course, the Apprentice biopic. Will it get you back into the theater if you haven't been already, Scarlett?
I don't know. I mean, this one I feel like I've seen on TV every day. I actually watched The Apprentice the first time around, so I'm not sure they'll learn anything but new, but I'm always interested to see how Hollywood does it. That does it for us. Balance of Power's up next. Have a great evening. This is Bloomberg.